While the market fixates on a 47% year-over-year collapse in earnings per share, Tesla is quietly sitting on a $16.5 billion cash fortress that suggests this isn't a retreat, but a massive capital reallocation toward a winner-take-all robotics monopoly. Good morning, and welcome to the CFO Suite Market Intelligence Desk. The narrative surrounding the electric vehicle sector has shifted from excitement to exhaustion, punctuated by Lucid Group's recent fourth-quarter earnings call. Lucid's struggle to scale production and manage high cash burn serves as a stark contrast to Tesla's 4% profit margin, a figure that, while compressed from previous peaks, remains a structural anomaly in an industry where competitors are hemorrhaging cash on every unit sold. Strip away the noise of the 3-year EPS CAGR of negative 33%, and you find a company that is no longer an automaker, but a vertically integrated AI powerhouse. We are seeing the iPhone moment for Tesla's full self-driving software, as the company pivots its primary engineering resources away from the $25,000 Model 2 toward dedicated robotaxi platforms in the Optimus humanoid robot. This transition isn't without friction. In India, the competitive landscape is shifting as Mukesh Ambani's Reliance Industries enters the fray, targeting the budget-friendly segment with smart glasses and robotics that could challenge Tesla's ecosystem in emerging markets. Simultaneously, the legal risks are mounting. The Delaware Court of Chancery's decision regarding executive compensation and ongoing Department of Justice probes into autopilot marketing have created a persistent valuation overhang. However, institutional capital is looking past these regulatory hurdles. The real story is the compute. Tesla is currently scaling its H100-powered cluster to reach an unprecedented level of training capacity for its neural networks, a move that separates it from legacy OEMs who are still struggling with basic software-defined vehicle architecture. The broader market is currently anchored by a teetering tech trade, with investors holding their breath for NVIDIA's results to validate the trillion-dollar AI thesis. But while the market waits for NVIDIA's chips, Tesla is already deploying them at a scale that dwarfs any other consumer-facing entity. If this level of institutional analysis is giving you an edge in a volatile tape, hit that like button and subscribe. We do this every single day to ensure you're ahead of the shift. Our earnings trend analysis indicates that the current TTM EPS of $1.01 represents the cyclical floor. The net income contraction of 46.5% is the price Tesla paid to maintain its market share lead against BYD and to flush out weaker domestic players like Lucid and Rivian. By utilizing its $16 billion liquidity position to fund R&D during a high-interest rate environment, Tesla is effectively buying the future of the autonomous, miles-traveled market. The transition from selling hardware at a 20% gross margin to selling FSD subscriptions and robotaxi fleet services at an 80% software margin is the fundamental catalyst that the current trailing data fails to capture. Watch for the deployment of version 12 of FSD as the definitive proof of concept. If the intervention rate continues to drop at the current velocity, the regulatory pressure will likely pivot from skepticism to a mandate for safety. We are also tracking the progress of the Dojo supercomputer, which could potentially unlock a secondary revenue stream through AI as a service, similar to how AWS transformed Amazon's valuation profile. As these high-margin segments begin to contribute to the bottom line, the current downward trend in EPS growth will likely undergo a sharp reversal. For those tracking the long-term capital cycle, the current entry point created by the Lucid-induced sector weakness is a rare opportunity to capture Tesla before it is re-rated as a pure-play AI and robotics firm. If you want to stay positioned on the right side of these structural market shifts, make sure to subscribe and join our community of sophisticated investors. Our confidence score for this bullish outlook is 80%. This analysis is powered by the CFO Suite.ai. For more institutional-grade financial intelligence, visit the CFO Suite.ai. This content is for informational purposes only and should not be considered financial advice. Always consult a qualified financial advisor before making investment decisions.